Okay, welcome everyone. Let's all start our second lesson. Today lesson will go through our LO2 learning outcome tool. Uh, During this lesson, we'll go through our LO2 learning outcome tool, which is about being able to critically analyze financial performance. So key focus will be financial performance. Before starting today's lesson, let's recap what we learned during last lesson. Anybody remember anything we learned last lesson during our last
Um,
lesson?
I didn't join last lesson. I couldn't able to join this last lesson.
Okay, in that case, the recording is available, so you can please listen. And
All right, that's
if you have
okay.
any question, you can ask. So we discussed last lesson costing and the costing system. We discussed marginal cost. Marginal cost mean variable cost. We discuss about absorption cost, which is also known as a full cost, where we discuss fixed and variable cost together and how we can observe into product. And then we discuss ABC costing, activity based costing. We discuss job costing. We discuss unit cost per unit. If we will produce more, the unit cost drop. We discuss about high and low method, semi-variable cost, where fixed and variable cost together. And we want to differentiate how much is a fixed, how much is a variable through using high and low method. And we discuss about opportunity cost. Opportunity cost is the cost, of missing opportunity. You're attending this lesson, you're missing other opportunities, so we always do cost and benefit analysis, which one is the better for us. So that's we discussed during our last lesson. So today lesson is about financial performance, and we'll go through how we can measure the performance of different company, different organization. Today lesson, key command verb, key verb we have analyze. So what is meant by analyze? Separate information into component and identify the characteristic. Discuss pros and cons. If somebody asks you analyze something, discuss the pros and cons of thing. So that's it's called analysis then. Apply, so you have to put in operation your knowledge, your skill, you have to apply. Like, you have a ratios, financial ratios, your knowledge or performance measurement knowledge will apply, and then you recommend you invest in this company or not your investor, or in anybody want to look around the performance. So today lesson is key inductive content, what we supposed to be learn financial statements. So we'll discuss financial statements. How many we prepare? We prepare profit and loss, also known as income statement.
Okay.
Second is balance sheet. Balance sheet shows assets, liabilities, and capital. And third is cash flow. Cash flow, it shows how much money in and out from the business. And then we have a different ratios which we call financial ratios. We categorize them into four major categories: profitability ratios, liquidity ratios, use of resources, and efficiency ratios. So all which we will go through today lesson. Okay. Let's please, what your current knowledge about financial statements and ratios? How much you know? If you reflect of 1 to 10, how much you know? What do you think? Scale 1 to 10? Yes, cost system we learned yesterday, which I mentioned you, and today we are doing financial statement and ratio. What do you think? Where you up to? You're 6, 7, 8, 5. Always good to be reflect, yes?
Right.
So, have you learned before? If not, about financial ratios or how many type of statement we prepare in accounts. Okay, if not, that's fine. If maybe you're on 4, you're a 3, you have a generic knowledge about, yes. So, okay, so 2.1 learning outcome 2 and assessment criteria 2.1, and we have analyzed financial statements, assess financial position of an organization. We'll assess financial position of the company. The objective of financial statement according to International Accounting Standard Board, IASB, International Accounting Standard Board, framework for preparation, presentation, financial statement. So what provide financial statement? These provide the information about the position, performance, changes in the organization, and we can make decision either to invest or not invest, apply jobs in this company or not apply. Because always good to be look around the company's financial position. If the company is not strong, not financially strong, maybe they're not able to pay you salary even. Yes. So always we need
Yeah.
to think about. So financial statement where profit and loss, balance sheet, it shows assets. So this one, first one shows income or loss. Second one shows our assets, how much worth of assets company have, like building, plant, machinery, how much liability, how much borrow money they have, and how much capital they have. Capital is mean investment. Okay. So if you want to see the cash, inflow how much cash in, and outflow how much cash out from business, so you can look around in cash flow. And if you want to see how many shares company issues, how much dividend company paid, this last statement is called statement of change in equity. Equity means share capital. So these are the 4 key statements. Okay, so what is a conceptual framework? Conceptual framework is set out the principles and the rules how we can prepare the financial statements. What rules, like what depreciation method. So normally these days we have a local standard every country, but plus we have a international accounting standard IES 1, which is about how you prepare and present financial information. So that's is crucial. Always financial information need to be true and always need to be fair. Yes, is matched with the reality. You saying you have a worth of stock in millions, but when will go? Okay, anybody still using Windows 98? Are you
No.
using Windows 98?
No.
Not anymore. Okay. Think about you have a Windows 98 CDs. You bought it £200 each CD for suppose back in 1998 or 2000. What do you think? What will be value of this? Still will be £200 value?
Of course not. No one want to use it even.
No one is going to buy it. Maybe
Yeah.
if really people want to buy in peak, maybe somebody happy to pay £10. Yes,
Yeah.
original
Yes.
genuine CD. So, but not 200. So if I'm telling I have a stock worth of £200 each CD and in millions, so I'm not giving the true information. No doubt there was back in 2000 or 99, but not anymore. So I should say I have a value of CD £10, not 200,000. So I should give the truth so people can know how much worth of the asset company has. So that's not, that is a crucial thing. Okay, then we have conceptual framework, going concern. Always the details give view that this company will be carry on business as normal at least 12 months. 12 months. If we'll see the company can't afford it to pay the salary to people, company don't have a asset, company profit is going down, it means that company is not a going concern. That company can't be carry on running at least 12 months. So we need to be tell the truth. We need to give the view. Okay, accrual basis. Always we do accounts on accrual basis. Okay, this year expense should be recorded in this year. It's not mean I want to save the tax. I can this year income I can move to the next year. Some people, couple of you heard about creative accounting. Some people are very creative. You maybe heard about the company called Enron and company called World Telecom. That was leading companies in the world. They showed million profit, but after few months they can't afford it to pay salary to their workers. Many people lost millions in through investment. So accrual basis, you should recognize income and expenses, costs, whatever in the year. Okay, so if you paying insurance, car insurance,
Yep.
yeah, let's say you paying car insurance for 12 months and you paid it on 1st November for 12 months. Yes. So our year finished 31st December, our accounting period. So our expense for this year is only 2 months. I can't say that payment which I made is expense because that's not expense. That's only expense. 2 months expense for this year. Next 10 months is my prepaid. I paid advance. If I'll sell my car, I can get my money back. I should say is my asset in my book of account, not my expense. If I'll put expense for 12 months, I'm reducing my profit. I'm paying less tax. So that case is carry on happening. So accrual basis, you should tell the truth. Okay, next now looking qualitative characteristic. What quality need to be in a financial statement? Financial statement need to be relevant. It should be true. It should be material information. Think about is a big organization, £1,000,000. Somebody stealing £10 out of from the company. Yes, first of all, shouldn't be happen. But if it happen, if we'll spend millions to investigate where my £10 gone, that's not a
Exactly.
worthwhile. So material, if I'll miss the transaction, like we have a company called Tesco supermarket in UK, one of the largest. So their profit was 180 million. 180 million their sale was, not profit. Sales, million, not billions. Okay. And they showed 220 million. So they showed more sales to attract people to be invest in that company. So 40 million is a fake figures in sales figure. So that's the material, yes. 40 million can make difference on you, on your perception about the company, that this company not telling you truth. So still is a criminal investigation against director. Okay, so faithful represent mean always give the complete, neutral and free from error information. Then we have a further enhanced characteristic. Enhance. We have a 6 qualities need to be in a statement. Comparative. Always good to be shows 2 years figure. 2 years financial statement. Last year, this year. That give the comparative. If it's a new business, of course, you can't give the comparative. You can assume it, some figure. You can forecast it. Okay, verifiability. Whatever we saying, it should be verified. We can verify what you have. Saying £1,000,000 worth of asset, £1,000,000 worth of liabilities, we can verify it. Yes. Timeline. Always when year end, within 2 months, within 90 days max, you should publish the information within 90 days. Yes.
Like quarterly, like VAT.
Uh, no, no, not VAT. It's like, your year finish final accounts.
Mhm.
Uh, our year finish is 31st December, yes?
Yeah.
So we should prepare our account within 90 days. Let's say yes. So if we am not preparing my account statement, profit and loss, and balance sheet and cash flow, so I'm producing, let's say I'm making this year account in next year in November. So it means I'm misleading. I'm not giving the timely information because at that point maybe everything will be different. Think about COVID 19, whatever the company position was before, and now it's totally different world. Maybe some gain 800% sales, but some is went down. So understandability. So whatever we do in numbers, anybody who have basic knowledge about accounting, these should be understandable. Understandability. So in like, it should be asset under asset heading, liabilities under liability headings. Yes, capital under capital heading, sales under sales heading, cost of sales under cost of sales. So these people understand, not, mislead them. Okay, as we discuss IAS 1 and the statement we prepare in accounts and how look like statement will be. So financial statement, profit and loss, always comes sales first. Then you have a cost of sales. Cost of sales, normally we use formula. We're not going through all the formulas. Opening inventory plus purchases minus closing inventory. Inventory means stock. So that give you the cost of sales figure. So your sales minus cost of sales will get the gross profit. Gross profit is not a net profit. Gross profit is mean the sale value and the cost value. Then you have other expenses, you have overheads, maybe you have other income. Maybe my main business to be sell the food, but we have a spare cash we invested in the properties and we in generating some income from properties as well. That can be other income. Are we receiving discount from suppliers? That can be income. Expenses we minus from overheads, indirect expenses, not direct, like accountant fees, like admin, like advertising. These are indirect expenses. So after we'll get the profit. Profit can be before tax, profit can be after tax. Okay. This is the balance sheet, or we call profit and loss. Okay, the second statement which will show you, this is the balance sheet. Balance sheet shows asset, shows liability, and shows capital. And this is also known as accounting equation as well. If you know asset, if you take out the liability figures out of it, it's your capital. Capital, like you bought a house, 100,000 pounds, and you paid 50,000 pounds. So, and you have a liability of 50,000. So if you minus 50, your liability, so your net asset is 50,000 pounds. So net asset figures always, it mean you have a capital in the house is 50,000. Rest is your liability. Who you can't say is your house is 100,000. It's not your house at the moment because you not make the payments to bank. So that's we can look around. Okay, non-current asset is mean long-term asset, like building plant machinery. Asset mean anything you own it, anything has economics value. Anything which will flow the future economics benefit we called asset. So as tangible we can see it. Intangible which we can't see it. Intangible. Like goodwill, reputation, like brand. Like think about Nike brand and various others. So current asset, any asset which carry on changing within 12 months, that is called current asset. The asset value carry on up and down. Okay, current liability, anything we need to settle, legal obligation within 12 months. That's the current liability. Non-current liability is known as a long-term fixed liability, which is takes more than 1 year to settle. Okay, then capital is mean investment. Last year capital plus any capital we introduce, we issue more shares. Profit or loss for this year and less drawing. Drawing anything you draw from the business for personal use. Okay, so all these terms we explained here. Yes, so please good to be read these slides. Okay, current asset, non-current asset, current liabilities, all. It's good to be at least basic knowledge. We don't want to be really make you, because this is the management course. As a manager, you should understand the figures. You interpret the figures. You make a decision through them. Yes, you're doing strategic management course really all about. Okay, so non-current liabilities, current liabilities. So all been explained. So today we'll look around two companies account. One is called Next. Next is one of the companies selling clothes. They have a supermarket with very popular. Next is various offsite throughout the world. Second is a Marks and Spencer, both British companies. And Next, if we'll copy, Next is known by the quality of the product, both selling clothes, different product. Even they have a food store, they're selling furnitures, and is around it's set is all been set up in 1800. So that's is quite old. So we can look around the financial performance of these two companies. Okay, so I'll show you in a minute. So it's always good to be look around the actual companies. So what you can do if you're working in a company, in an organization, always good to look around your own company, yes? So that then your knowledge will be really practical knowledge. Always good to be look around. Always try to be apply the theory, because otherwise theory is no benefit. Okay, so we come on, sorry. Sorry guys, this is a bit technology slow.
It's alright. Because of the COVID, everything is slow now.
Oh, yes, it's a lot of load. Many people using it. Okay, so this is the next. Yes. So it's slightly old accounts. We can look around the latest even as well. Yes.
It's 819
So
accounts.
what we can, if you look this content page, and you will see the all statements. Yes. So we have consolidated incomes. Consolidated mean they have so many companies. They have a subsidiaries, sub companies. So that's why we combine the statement. We call consolidated. Okay. So this is the income statement, also known as statement of comprehensive income, balance sheet, statement of change in equity, and the cash flow statement. And we have on page, so we can go on page number 115. Yes. So here, no, 11. Yes. So I'm here 115 page. So you will see here statement of comprehensive. We can look around 2 years. This one is better to look 52 weeks in a year.
I'm sorry. I forgot what's the meaning of consulate?
Sorry, which one?
Consulate.
Consolidated.
Consulate income. Yep.
Consolidated mean combine.
Combine. Okay.
So like we have a group, in our group, in next group, we have a company A, B, we have a textile company, we have the construction companies, we have so many our subsidiaries. Yes. We
Okay,
open
like one company has quite loads of group of company. You mean
a lot
that
of
one?
group of, and as a group
Oh,
we are making combined statement.
okay.
Okay, so we'll see here continuous operation. Continuous means the business will carry on running. Okay, so we have a revenue, how much sales we have. These are in million, 3917 million. Yes. And last year was, you will see there is an increase in million sales. Then we have a cost of sales. This is all about the cost of sales. You can argue there are a lot of sub adjustments. So if you want to read thoroughly, you can go through these notes. Under these statements, we have a note, full explanation where these figures came from. Yeah. Okay. Then we have a sales minus cost of sales. We'll get the gross profit. Then we have other expenses, which we call overheads, distribution, admin. Either we have a gain and loss of various other incomes. Then we have operating profit. This is operating profit. And then we have finance cost. Finance cost is mean our interest, how much interest we paid. 0.4 million interest we paid. Sorry, 39 million we paid interest. This is finance income. It means maybe we have invested our money in saving accounts and we have other income. And that's the finance income, that's the finance interest. If we borrow money, we pay interest. That's called finance cost. Okay, so then we have this and how much tax we paid. After tax, we have a profit this. So this profit we can contribute, give to the shareholder, but normally we're not giving all the profit. We give, and if we look how much dividend earning per share, how many shares we have, 435 pence per share. So it means £4 and 35 pence per share we pay to our shareholders. Are they earning per share? So we can find what is the value of the shares and we can look around. Then we have a balance sheet. Its balance sheet shows last year and this year assets. So if you look last year non-current asset total 764 million and it went up 779 million in the 2 years. That's why comparative figures 2 years. People can see. If I'll give 1 year, people can't see what's happening. So then we have a current asset. So last year and this year, it went up. What happened? Total assets both. What happened? Total liabilities. And what happened? Total equity. You will see their net asset figures is equal to equity figures. Okay, that's the balance sheet. Then you have a statement chain in equity. How much dividend you paid? How much share you issued? All we have here. Yes, so you can see this year, you can see the last year, and you can see the increase and decrease. And overall, what we have now, equity figures, 563 million. Then you can look around the cash flow, how much money in, under operating. Operating mean our normal business. How much cash in and out. We have a positive cash flow. And under investing activities, how much money in and out under that cash is went out from the business is a negative cash flow because outflow is more than inflow under this section. Then under finance, if we look under finance, we have a outflow, not inflow. It means we settle the liabilities, we settle the things, the cash went out. What is net my cash balance? We have a 24 million. And last year was negative cash flow, but this year we have a positive cash flow, which is a good sign. So what's happening last year and what is my closing balance? So this is we prepare in the cash flow statement. Okay, that's all the information for this company. Same way you can look around the second company, you can compare, you can argue whatever you want with it, yes? Okay, next we look at 2.2. 2.2 is recommend organization-based decisions. Yes. So which we look at how we can recommend financial statements on their own or limited use. But main thing you interpret them and how you make the decision based on the information we have. That's the crucial thing. Okay, then financial statements always we need to interpret. If the information was really good, maybe last year, but think about COVID-19, so we should look the latest one.
Mhm.
Yes, due to the COVID-19, the sales dropped because the store were closed. Many companies is going to be even liquidate. Yes, liquidation. They are going to close the business, even they're struggling to sustain. They have to pay salary, they have to look around after friends and a lot of expenses. Okay, so that's we need to look around. Any question, anyone, please? Is the background noise a bit?
No, it's fine. Thank you.
Okay, next please. Ratios. Next we will going through the ratio. That's the key topic. Ratios is a financial ratios is a relationship between two things, and always we have these ratios. We'll use go through these ratios in liquidity, profitability, financial, and use of resources. And we have a formulas here at the top. So you will see the graph.
Liquidity, profitability, financial goals, use numbers.
So current asset divided by current liability. I can find the figures from statement of financial position we call balance sheet, the figures, and I can use the formula and I can calculate. Okay, same way we can look around the quick ratios. Quick is mean most liquid, current asset minus inventory divided by current liability. Normally benchmark is 2 to 1. £2 worth of asset if you have, £1 liability if you can, which is most liquid position of the company. But if not, it varies industry to industry. Then we can compare last year, this year, and industry averages. Then we have a financial position, also called gearing ratio. What happens if you drive in a high gear? High gear is a high risk. If your gearing ratio will come high, it means your borrowing is high in the company. So if it is more than 60%, which is not good for the company. It means 60% your company is owned by your creditors, your the people you borrow money from them. You only own it 40%, and you're saying it's your company. Yes, interest cover ratio is mean how much interest you paid against the profit. Maybe you have a profit, but all the profit going towards your loan payments. So that's we need to look around. Then underneath we have other ratios like we have profitability ratios. So you can look around the profit from operation divided by these. You can look around the gross profit divided by revenue, and these ratios we can calculate. And inventory, turnover, and inventory, these are called use of resources. How quickly you selling the stock? Because really, as a business, your stock come and sell, stock come and sell. So you have a less storage cost. You're efficient. You're really quickly selling the thing. Always good for business. Is more cash flow. Okay, so financial statement. We'll calculate these ratios. Yes, ratios help. Every ratio has been explained here as well, please. No, I'm not going through all, otherwise you can't finish it. But you can look around. Yes, you can read it with all interpretation of reason, please. Okay, so we can look around. Now we look two companies. Okay, I'm going to send you this handout as well. Yes. Okay, so please, this we can look around. This we have a company called Anika and Kapika. Let's say two companies. Yes. We can apply same in the real companies as well. So we have a revenue, we have a cost of sales, we have a gross profit. Yes. and we have all the other expenses, and we have a profit from operation. Then we have a balance sheet, and we have a current asset, non-current asset, we have a total asset, and now we'll use the formulas. We've been given the question and we've been asked to calculate these ratios for these companies, yes? And which we are going to calculate these ratios for 2 years. So, and comments on ratios. So what we done 2 years ratios for this company and both companies. Can we see, yes?
Yeah.
Okay, so what we done, gross profit divided by revenue, and it's coming 45%. So whatever we selling, whatever cost is, and we generating 45% our profit. So if we generating 45%, it means 55% is my cost, because everything, my revenue is 100%, my profit is 45%. Where is my 55%? 55% is my cost of sales. Any
So
question?
is it 55% is the cost?
Yes, it is
5% profit.
Yes, let's assume you're £100 worth of the goods, yes?
Right.
You sold it on 100, yes?
Yep.
But it cost you 55. Your profit is 45.
Okay.
Yes?
Yeah.
So because we're saying gross profit divided by, like, normally we say the total, what marks you got out of total marks, yes?
Okay.
So this is the way, time by 100, so we calculating. So last year, this company, Papika, other company, they was 52. So which one is the better? If we compare two companies, Papika and Anika, so Papika was better because they have a high profit, 52.
High profit, yeah. 52.
We have a 45, yes?
7.5, yeah.
So they are 7.5 is a higher than other. Okay, but if we look operating profit, operating come after all the expenses, yes?
Yeah.
Not direct cost only. So this has the 9% operating profit and this has 11%. So still Papika is better than Anika, yes?
Operating profit ratio. Is there operating profit ratio? What does it mean, operating profit ratio?
Operating profit mean the profit from our operation after meeting all the expenses.
Okay, got it. Okay.
Because this is only, let's say, you're buying cars, you're selling cars, yes? So you're buying and selling, the difference is your 45%, you're gaining it. But you have other expenses, you have a rent, you have a rates, you're paying advertising, yes? Indirect costs. So then you're saying what you're saving net is 9%, yes? Okay, next we have a gearing ratio. Gearing mean if you drive a high gear, high risk, yes? High debt. So debt divided by debt plus equity. Equity mean is shares. Debt mean you borrowing, debt financing, loan from the bank. So 4,000 divided by this is coming 13%. How many percent? 13% your gearing. We said if it's more than 50, then is a risky. If less than 50 is less risky. Yes? Like gear, if you drive in a high gear, high ratio, high risk. So this is 13. And Papika is how many? 71%. So which one is a better? Anika is a better than Papika.
Yeah.
Because Anika is less risky than Papika. Okay. Different in a list, you two different formulas. So this is one of formula and this is one of formula. So if we just look the debt divided by equity, this is coming 15%, which is very less as well. So it means 15% companies owned by the debtors, by the creditors, basically those give us money, lenders. 85% company we own it, yes, which is good. So, but in other case, in Paprika, 245%, so it means we own nothing. It's not any our investment. All the investment is outsider, huh?
Yeah.
It's more risky. Okay, then we're looking the interest cover ratios. And interest cover is profit from operation divided by finance cost or interest paid. So how much is operating profit we have divided by how much. So how much is my operating profit is higher than the interest cost. 11 times our profit is more than our finance cost, which is good. If your profit drops, still you can afford it to pay back money your banks interest. Yeah. So in this case, this company Paprika is only 3.1%, one times, not percent, times, yes. So which is less, this is more risky. Paprika is more risky, yes.
Yeah.
Because the Paprika's profit is very less, is only 3 times more than the interest. Okay, then we look the current asset or current liability, or we call liquidity ratios. So this is most liquid. Sometimes stock we can't convert it. Liquid mean anything you can convert into the cash quick. Cash itself is a liquid. So it sometimes stock people not going to buy, like Windows 98 CDs may be out of date, yes, out of fashion. So we not consider in calculation this ratio. Current asset minus inventory figures, and what is my most liquid assets divided my current liability is coming 1.22. It means every pound 1 pound 22. So it means we have a more assets. Every 1 pound 22 pound pence worth of asset, you have 1 pound worth of liability. Your liability is less than the assets. Yes. If you look the top figures is the higher. If you look the denominator figures is the lower. Yes. Which
I
is
didn't
good.
get the acid test, so
Sorry.
I didn't get the acid test.
Asset test is in total current asset.
Right.
We take out the inventory. Inventory means stock figures, because sometimes stock can be outdated. Yes. So we
Yeah.
want most liquid, anything which we can convert into the cash quick. So then we have a asset figures is 4747,
Yeah.
and our liability figures is 3876. So if you look at the top figures is higher than the bottom figure, yes.
Yeah.
So it means your asset is more than your liabilities. So your asset is 1 pound and 22 pence, and your liability figures is 1 pound. So which is good. Your liability is less than the asset, yes,
Less than the asset. Yep.
which is good sign. But if you look in Paprika, they have only 65 pence of asset against 1 pound of liability. So they have,
So
if you,
less profit. Yeah.
so if they have a less asset,
Less asset. Yeah.
so less liquid asset, huh?
Yeah.
So each section we can compare and we can argue, yes. So we can say here this, which one is a better, which one is not, which one is more risky, huh? Which one you invest, why you invest in which company, yes. This is all our conclusion. Our analysis measuring the performance of the company. Okay, so that's the way we can. I included the slide. You can go through, guys. Yes. Okay. Then next we have a 2.3. Propose the managerial recommendation. You can recommend it to managers which one company you go, but not only recommend based on the ratio. You always look micro environment. Micro environments, it mean you do pest analysis. So especially especially IT company will grow more, especially online business will grow more. Why? Because of the COVID-19 next year, we don't know when this finishes,
Yeah.
especially pharmaceutical companies, yes, those making these
Yeah.
medicines. So they will maybe earn billions, yes,
Yeah.
and we can do a diagonal or horizontal analysis of the company. So we done here, we can go through the industry average, what is it happening in the industries. And then we can look around, consider the strategy as a company, yes? Like strategy, think about your trade receivable days. We're receiving money in 30 days, you look always, you look how many days you paying, yes? How many days you keeping stock average. If your stock carry on coming and quickly convert into the cash, you sell it, always better, yes? You not just only look the long profit, always good to be your cash come quicker. Cash is a lifeblood for business. Maybe you have asset million, but you don't have a cash. You can't really sustain it.
Yeah.
Okay, all this it's been explained. Okay, then we have investors. As we've seen, investor can make the decision based on the profitability ratios for scores. You can different people can make different decision based on the information. Like in this case, in Papika and Anika, yes. So maybe the company and Papika has interest cover ratio is very
Low.
high. So
Oh, it's low. I
Papika,
high. Yeah.
Anika is less risky than Papika, yes.
Oh, yeah.
So if you're
I
a
got it.
lender as a bank, you can give more borrowing to Anika than Papika. Yes. So you can make the decision. Okay. Then I copied the link for you to do the quiz. Yes. So what you can do, copy this. Yes. Link in your own time. It's good. I'm not taking your test, but you can copy this and you can play with it. Yes. It's tell you you right and wrong. Yes, like here. So you can look around. This is all about the ratios. Even you can review. You can start it again. Huh? Okay, so please do your own time. Huh? Financial
Sure.
ratios user, so you can pick it. Huh? Like if you do the right and wrong. Huh?
Yeah.
This way. At the end will shows you all and you can review. Huh? So this is this. Uh, and all these recommended resources. If you have any question, you have my email address and you can drop me email anyam@ukversity.co.uk. Okay, so today guys we learn about how many types of financial statement we prepare, how many types of ratios we have. We discuss about profitability, liquidity, use of resources, and
Cash flow.
gearing ratios. So that's all today, and I shown you actual company's financial statement, link given in the slide, so please you can use as well. Huh? So that's all today lesson, and I hope speak you all during our next lesson, which will be next Saturday. Huh? Thanks for
Um,
listening and attending.
I have one question, sir.